Thank you. Yeah, I should say I'm a former UK financial attaché, so I have a lot of sympathy for what Peter just said. I thought this conference was ideally timed because we thought this was going to be the end game of MiFID. MiFID and MiFIR, didn't we? And taken together with EMIR, now moving on to level 2, we could talk about the trading landscape and market structure, but MiFID seems to be temporarily dead, at least in the council, or at least in a coma, perhaps, for a couple of months. And I think, Peter made some very important points there. I think trying to capture all the different issues that MiFID raises in one piece of legislation is incredibly difficult because, as Peter correctly pointed out, the markets we're talking about are fast-moving. It's like catching a fish, I guess. They're global. There's always potential for arbitrage, and they're always moving faster than the regulators are. And I think MiFID, and particularly MiFIR, I always compliment the Commission on at least trying to have a comprehensive securities law. And when you compare the situation to the US, I think Peter again was hinting at this, European theory is in a stronger position. The US had a bit of a mess pre-Dodd-Frank. Dodd-Frank is huge, isn't it? 2,000 pages? Goodness knows how many thousands of pages of secondary regulations to follow. At least Europe had a comprehensive securities law in the ISD and in MiFID. But I think that MiFID 2, and particularly MiFIR, almost collapses under its own weight. And I have tremendous admiration and sympathy for both the MEPs and the member states trying to wrestle with it. The micro-regulation of how commodity markets work or how voice brokers work or the calibration of pre-trade and post-trade transparency isn't really something that should be in primary legislation. But it's in there because these issues become so sensitive. And of course most member states haven't the faintest idea what these things are anyway, because they don't have these markets. There's only a couple of countries that actually have securities markets of any size. So it's like the blind leading the blind in the council to some extent. So, and I always think that in a way MiFID is too ambitious. I know some of the MEPs, Peter, thought perhaps it should be broken up. And I have a lot of sympathy for that too, because if you think about it, what it's trying to do is a number of different things. And I'm putting aside the huge agenda on investor protection, which we talked about in the previous panel. Just put all that aside, which is in itself a huge agenda and very important. Even just in the sort of market structure area, is trying to tackle the residual issues from MiFID 1, particularly in equity. So market structure in MiFID 1 was all about the equity markets. And so in particular, it's looking at the off-exchange trading, this mythical 40% that's still OTC, what to do about it, the broker crossing systems. It's looking at high-frequency trading, technology developments, keeping up with technology, the fragmentation of data, which is a consequence of MiFID 1. That alone is quite a big agenda, like a follow-up to MiFID 1. Is then trying to extend that to fixed income, the whole pre-trade, post-trade transparency to fixed income. Thirdly, is trying to tackle the G20 derivatives agenda, what the Americans call the swap execution facilities, having organised platforms for derivatives. It's also got a huge commodity agenda in there as well. Again, each of these is probably worth a piece of legislation in its own right. And on top of that is trying to ESMA-ize, to harmonise, deliver a further level of harmonisation, which I think is appropriate, particularly on conduct of business rules, but also to some extent on market structure. And finally, and this is something I'm happy to come back to later on, it tackles the issue which most people don't talk about very much, but it's very important for the markets because they're so international, is it tries to tackle the question of third country treatment, tries to Europeanize the treatment of third country firms. Each one of those is actually very complex in its own right. So I'm not surprised in a way that the Council in particular is stuck. And at the same time as these long European negotiations take place, as I said, markets move, IT moves faster than regulation, and these markets are global. I mean, the commodities markets, somebody in the commodities markets told me that 80% of all commodity trading is now essentially Asian. So, European regulation of commodities almost becomes increasingly pointless, doesn't it? And I also think that it raises, increasingly market structure regulation, raises important questions of antitrust or competition policy. And sometimes I also wonder whether these things should just be handled by the antitrust authorities. So let me quickly just summarize, the three main asset classes, and then we can talk about them in more detail. In terms of equities, I think what MiFID 1 did essentially was try and deliver more competition, but actually what it was doing was just keeping pace with a move to electronic trading. I remember going to the trading floor, I better not say who it was, one of the largest asset managers in the world about 20 years ago, and they very proudly showed me their latest bit of technology for handling orders, which was a little yellow thing called a post-it sticker. When the traders would walk up and put the post-it sticker on the central dealer's thing, and then of course he'd phone his friends at the market makers or the voice brokers. And that's gone. Right? It's all electronic now, in really quite fast order. I'm embarrassed to say old enough to remember the negotiations on the ISD, the Investment Services Directive, which were all about the market-making structure that many of the continental regulators saw as dominating the markets in London versus the order-driven markets. Most of these markets in the equity field have become order-driven markets, so that debate was slightly redundant. But what you've seen, I suppose, is trades become faster, spreads, costs fall due to the competition. You've seen speed increase to nanoseconds. You've seen the growth of high-frequency trading. You've seen the growth of these crossing systems, although they're still relatively small. You've seen data costs rise because of, if you want to trade Vodafone, which in the old days traded on basically the London Stock Exchange, it now trades on 34 different platforms. I think there are 84 different platforms trading now in Europe. So if you want to get the data from all of them, that's going to cost you 84 times the cost of market data. What does MiFID II do for equity markets? I'm not sure it does a lot, to be honest with you. Huge argument about the OTC bit and should the broker crossing systems be allowed. It seems to me, at least in the last text, they're probably going to have to become quasi-exchanges, MTFs to use the jargon. High-frequency trading will still be there, be more highly regulated, but it'll probably still be there. I'm not sure that there's a huge change in market structure for equities. I may be wrong. Interested to hear what you people think. I suspect one thing we will see is concentration. This is all about scale, these markets, and we haven't got scale in Europe with still 84 different platforms, still a lot of national exchanges. I suspect you'll see scale over the next 5 to 10 years. Fixed income, that's the big radical change. Moving on, that was going to be the radical change for MiFID II, applying the market structure rules to fixed income. Again, I think it was about 7 years ago when I worked for an organization in fixed income. I had two major meetings, one with the sell side, where I said, look, you now have to start thinking about how to apply the equity type rules on pre-trade and post-trade transparency to fixed income. In a room full of dealers, I was virtually thrown out of the room. The French head of bond trading at one major firm said I should be fired on the spot. There was a German guy from another major firm who said I was a complete idiot. But of course the Commission were indeed working on applying MiFID I rules to fixed income. I then went to a meeting of the major investors, typically the life insurance companies, and said, you're going to have to think about pre-trade transparency and post-trade transparency if you're fixed income. These guys buy 100 million, 500 million, and it was just stunned silence. And again, they said I was a complete idiot and was kicked out of the room again. So I suppose if I annoyed both the buy side and the sell side, I was probably doing something right. So I think the problem with fixed income markets, as we'll talk about in a minute on derivatives, is essentially they're illiquid. I mean, most bonds don't trade. And when we did, the organisation I work for, we did a huge piece of research that showed that most bonds don't. I think a typical bond trades twice a day. And that's actually distorted, as you probably tell me as an academic, by the first couple of days when you issue a bond. They don't trade. So liquidity isn't there. So you have to find liquidity, and it's what dealers do. So in a sense, the whole problem with fixed income markets, both cash and indeed derivative, is where the liquidity comes from. You can't mandate liquidity. You can't invent it out of thin air. So they've really struggled, I think, to think about how you calibrate, which is the buzzword, how you calibrate your pre-trade and post-trade requirements to fixed income. It looks like the Commission thinking is you have to have these things called systematic internalizers so that dealers have to display their quotes and all this kind of stuff, all to be calibrated. But if you calibrate, for example, by large in scale, well, from the perspective of those big life insurance companies I met, all their trades are large in scale. They may not do them very often. They may trade the Daimler Chrysler 2016 bond or whatever, every 6 months. Every time they do it, it's a big trade. So what's the average size? It's going to be big, right? So it doesn't calibrate, again, to use their word, very well. So what will happen in fixed income? I think a lot depends on the calibration. I think if the rules go through and they're slightly clumsily drafted, and there's always a risk of these things, then your liquidity in the fixed income market will fall. That's what, by the way, what the dealers will tell you happened in the US with even just introducing Trace, which is post-trade transparency. It looks okay, Trace, but actually the dealers will tell you that they actually provide less liquidity. And they make more money out of trading on an agency basis rather than a dealer basis. So the end customer basically pays more. Thirdly, then briefly on derivatives, which I guess we'll talk more about in discussion, and Alex, I'm sure, will talk about derivatives a lot. Derivatives is of course, the one thing that is dead urgent to do to meet the G20 obligations, to trade the standardized derivatives, well, to clear the standardized derivatives in EMIR, and then to trade them on organized platforms, or most of them on organized platforms, as soon as possible. Hugely controversial. Most of the clearing, actually, I think, is already happening. I mean, the banks, major dealers were all told, some time ago, you've got to start clearing this stuff. You standardize the CDS market, that's mostly cleared. In the fixed income market, again, largely standardized, increasingly cleared. So from the point of view of the regulators, moving this stuff onto clearing has either happened or is in the process of happening very quickly. Trading, I think, very unclear. So that's also where, both in the US, actually, the final micro details of these rules for trading systems, we're still waiting for them from the US. The MiFIR rules also slightly unclear, probably to some extent waiting to see what the Americans do. Again, the devil will be in the detail. If you get it wrong, then liquidity will just dry up, and Alex, I'm sure, will talk about that more. What does it mean then in terms of what MiFID 2 is likely to do for market structure and derivatives? Well, one, you get more centralization of risk in the clearing houses. It's kind of obvious when you think about it, but I'm not sure the regulators had thought about that when they said that everything should be cleared. Now you've got to think about how you regulate clearing houses and how you deal with huge systemic risk in a number of places, in a number of relatively few places. It also raises the cross-border issue. Can you have cross-border CCPs? We don't know. It's going to probably increase transparency in the derivative market. We think that's a good thing, as long as it's done right. There is, you can have transparent trading systems like request for quote systems, still dealer liquidity behind them, but still a huge amount of pre-trade transparency in there. On our systems, you look at the trading systems of Thomson Reuters, huge amount of data there. TradeWeb, an exchange that we mainly own in fixed income, huge amount of pre-trade transparency on there. Key question, will the regulators on both sides of the Atlantic allow that kind of liquidity? It's not an order-driven system like the equity market or the futures market. Is it satisfied? Does it satisfy their requirements? We're still not quite sure. But probably more transparency. Costs, we don't know. I really don't think people know what the consequences of all this will be. The end cost to end users. All kinds of complicated cumulative effects there. The margin requirements of clearing, the spreads, trading fees, access costs. Nobody really knows, I don't think, whether the costs are going to go up or down, nor do we actually know whether regulators care. Transparency to regulators, by the way, I should have said certainly goes up due to the establishment of these repositories. That's a very good thing, and they're up and running already. And then finally, a question that, again, Peter touched on. Are these markets just going to go? Are they going to go to Asia? Or are markets going to become balkanized in some way and making international trading much more difficult? The extraterritorial application of US rules certainly is causing huge problems and is unresolved. We're still waiting for a paper from the US on their solutions for extraterritoriality. Europe seems, very unfortunately, to be thinking of copying the American approach, which frankly doesn't make much sense to me. Apply a sort of Fortress Europe extraterritorial approach. So I think, we simply don't know whether these markets are going to fragment further or possibly move to Asia. I'm not sure they can move to Asia. But certainly, from the point of view of the end user, it's going to be much more complicated. Thanks very much.
Thank you.